Joins us now, SVP Energy International founder and president. Sarah, I've got Brent crude down by nearly 10% right now. Can you give us a little bit of insight as to what you see happening next? This is a very, very ugly session in the crude market.
It is, especially considering that investing in oil stocks and refineries was the only, the last escape for most of the investors. So what is happening is the market is really fearing a recession and the significant demand destruction for oil. So that has been had impact on oil prices, but obviously the gas prices is different, especially in the European region. But on the oil, the fear of recession, the economic slowdown, and the global reduction of oil demand is the major fear and reason behind that.
Sarah, I'm curious about the trade-off here between natural gas prices and oil prices. I mean, this is something that we talk about in Europe a lot, but perhaps not in the United States, where the natural gas market is perhaps a little bit more insulated, just given it doesn't have the massive kind of export market that perhaps Europe does. I have to ask, though, when it comes to utilities that use that natural gas, it kind of seems like oil, relatively speaking, is cheaper. Can you speak about the trade-off between the natural gas and oil story within the United States?
Sure. Something that is interesting is that if you look at the price increase of different energy sources, the crude oil price increase, even before it starts coming down, was much less in terms of growth than looking at natural gas and coal prices. And we are expecting that the natural gas prices is still increasing. Well, it's comparing Europe and US, we are having different results. Obviously, US produces a lot of natural gas. Most of US problem as of now is lack of refinery capacity, which has led to higher gasoline prices. Also, the increasing demand during the summer driving season. But looking at Europe, the story is different because Europe is not a major producer of natural gas. Most of the gas in this region is imported. And most of the, as you said, the utilities and power generation is from natural gas, which has been clean. Nuclear, coal, oil, these are the ones that have been kind of the less priorities.
How different are the energy markets going to look on either side of the Atlantic? So we've got crude prices coming down very sharply, US nat gas prices under pressure. But in Europe, Gazprom's going to go into maintenance on Nord Stream 1 next week. We don't know whether it's going to be turned back on again. Gas prices could explode higher. Energy costs could explode higher in Europe at the same time that they're falling sharply in the United States. How is this going to work?
Well, the thing is that even if you think that US could export significant amount of LNG to Europe, two things is involved. One is the cost of producing that, liquefying that gas and exporting that. Also, the gas prices in that region. So obviously the suppliers are offering higher prices to match up the prices in European region. So as I said, there is a huge gap really significant gap between the natural gas prices in the US and in the Europe, because Europe is mostly importing. Russia was a major supplier, and importing LNG is different. But I want to mention something that is important. As natural gas prices goes higher and higher, is not just the impact, the pressure on consumers in terms of the utility and electricity prices, but on the food, because most of the fertilizer around the world and in Europe are produced from natural gas. So when the prices of gas goes higher, the prices of fertilizer goes higher, or the volume of production will come lower, because many of factors will reduce their production or production of fertilizer, which has direct impact on food prices.
Sarah, I want to talk about the market dynamics as well. You just talked to us about the fundamental ripple effects here, but I'm curious about how much active participation is actually in the commodity market right now. If you look at the stock market, not everyone is actively trading stocks. That's one of the issues that you're starting to see in a market that's tanking. Could you apply the same logic to the commodity space, where perhaps a lot of people are either dodging the volatility or going in 2 feet in and diving in and saying, this is the macro hedge that we've been waiting for?
Well, the market is very unpredictable, and it's very hard to really anticipate the direction of the market. As Guy just mentioned at the beginning of the program, how the oil prices are dropping when just a couple of weeks ago everybody was worried about them increasing, putting pressure on OPEC Plus to producing more. So the market is very uncertain, and unless you are using this volatility to make money and your confidence that you made money, not lose money. Otherwise, for most of the investors, certainty in the market and predictability is what they require for investing. And all these news of recessions and economy slow down, no one knows where the bottom of the market is. So it's really hard to have lots of active participants.
Sarah, the only person probably that's going to be super happy with what we're seeing on the screen right now is President Biden. You've got oil prices coming down very sharply. In theory, that should mean that gasoline prices come down fairly sharply. How quickly and will we see the lower oil price translating into lower petrol pump prices in the United States, gasoline prices in the United States?
That's a very good question, because that is not going to have a same amount of impact on gasoline prices, because most of the gasoline providers had done these purchases prior to the current prices. So we see that lag of adjustment. But also something that is very important is the lack of refinery capacity. So if the crude oil prices shrink significantly, because a significant amount of refinery capacity in U.S. because of the ESG factors have been reduced or just really went out of the supply chain, we have that problem in the United States. So again, there is this difference. We need the prices of oil, crude oil might reduce, but we need that refinery capacity in the U.S. that we don't have that and is lacking at this moment. So we're not going to see that impact as quick and as significant that we are seeing on the crude oil prices.
Sarah Vakhshouri, SVB Energy International founder and president, thank you as always. As we head to break here, we're looking at Brent crude, a 103 handle, NYMEX crude, a 99